Hey everybody, it's Mark Yegi. The video you're about to watch shows you kind of the philosophy and the mindset behind why we get into the stocks that we get into in the cash flow machine. Let's talk about some of the cornerstones in the cash flow machine. It's actually a very simple system in its design, but there's little nuances and things like that are going to be a little bit complicated in the beginning, but over time, as you put your money at risk and you learn, you're going to figure these things out. But I want to try to save you as much pain as possible by trying to take you back and just focusing on the fundamentals. The fundamentals of the cash flow machine, I'm going to call them cornerstones. Now, here are the cornerstones as I see them. Number one, we assume that we want to own a stock longer term. We don't want to be day trading. We don't want to be weekly trading. We don't want to be getting in and out of stock because there's something called slippage that costs you money every time you get in and out of something, and that takes away from your profit. So we want to be in a stock that we like, that's growing, that's longer term, maybe trending sideways or up. We certainly don't want to be in a stock that's trending down if we can help it, but we can also do okay in a stock that's trending down. The bottom line is we want to be in a stock that we want to own longer term. And if you want to own a stock longer term, you don't want to own a stock that's going down, right? I mean, obviously. So this is, you're assuming that this is a stock you want to own. That's a pretty good assumption. Number two, we want to assume that the stock is not going out of business. Obviously, if we want to own it, we wouldn't think it's going out of business, but I have to say it anyway. The whole thing here is to choose a stock that is got good institutional support, that's got good volume, that's got good numbers, it's got good growth, good management, good products, things that you want to own. Like, let me give you an example. I mean, if you think Apple's going to sell more phones this year than they sold last year, that's probably a stock you want to own. If you think Apple is going to be around for a while, that's probably a stock that you want to own. Apple could go up and it could go down for sure, but it's certainly not a stock that you think is going out of business. You don't think somebody's going to put Apple out of business in the next 12 months, right? It's probably pretty unlikely. And so that's a stock that you want to, that's an example of a stock that you want to own, okay? Number three, the stock goes up and the stock goes down. And all we do in every period, we just sell the in the money or at the money calls. We do it weekly, we do it monthly, whatever you're deciding to do. That's what we do. We never waver from that. We don't decide, well, a stock is going down, so we're just going to wait until it comes back up. We never decide the stock is going up, so we're going to sell out of the money calls. We just do the same thing every week. That's the system. There are other systems out there, but it's not the cash flow machine, right? So we're always selling in the money or at the money calls, whether the stock is going up or whether the stock's going down. I'm going to show you how that works in a second. And that means basically that each period, maybe it's a week, maybe a month, we collect net juice. Now, when we sell, we're doing buy low, sell high in the opposite direction, right? We sell high and then we buy low. So every week, when there's some time left to expiration, there's something that we call juice, which is the time premium. That time premium always declines as it approaches expiration, meaning at 3:59:59, right before 4 o'clock on Friday, there is nothing left in time premium. Nobody would spend any money to buy any call that's out of the money, certainly, at expiration. And the only thing they'll spend at 3:59:59 to buy even in the money is what we call protection amount. So you have to understand that on Friday at 3:59:59, or let's just call it 4 p.m., there is zero juice left. Zero juice. So if a week before you sold it and you got $5 in juice, that $5 declines over that period of time. You kept the $5 and you have to buy it back at zero, right? And so we roll it to the next week or the next month or whatever period you're using. And so that's the way it works. We just collect the net juice every week. If you start worrying about what the stock is doing and the time premium and you have to pay to buy it back, it's gonna mess up your accounting, it's gonna mess up your brain. So I want you to keep focusing back on this cornerstone that every week, every period, we collect the net juice. Now, I just kind of alluded to what's called time decay, and that is that the juice decays as it approaches expiration. I don't care if the stock goes up 1,000 points, there is still zero juice left when that call is expiring. If it goes down, there's zero juice left. If it goes up $2, there's zero juice left. There is always zero juice left when that call expires on Friday. I hope you get that, because that's a cornerstone of what we're doing here. And that's what time decay is all about. So let me just kind of outline it. When we sell, we collect juice plus protection amount. Okay, we'll call that PA, if there's any protection amount. So for example, let's say the stock is at 100 and there's a strike price at 100. Well, when we sell it, we pick up $2. Maybe that's what the price is. But since it's at the money, there is zero protection amount. It's all juice. It's all speculators that are saying, well, I'd be willing to spend $2 to buy that stock anytime in the next period, week, month, whatever, for $100. So they're willing to spend $2. They're the gambler. Remember this, right? And so as the gambler, they pay that. You collect it. You're the seller. You give them the right to take your stock. If the stock is at 105, for example, and you're doing the 100 strike, that's $5 in the money. So you get $7 for it, let's just say, which means in this case, it's $2 of juice and $5 of protection amount. Since it's $5 in the money, that's protection. That means the stock could go down $5 and you still haven't lost any protection amount. Now you're potentially just risking juice. So the stock could go down $7 for you to break even. I hope you get this by now. All right, so now that we've got that call, we've done the sell side. When we buy it back on the other side at the end of the period, because in the cash flow machine, we roll to the next period. We roll from Friday to Friday, or we roll from the third Friday of the month to the next third Friday of the month, or whatever we do, the period, I'll call it. When we buy it back just before it expires, maybe at 2 or 3 o'clock on Friday, there's almost no juice left. Let's just call it no juice. I mean, it's 10 cents, 20 cents of juice. The rest of it is any protection amount if it's in the money. Does that make sense? So back on our $100 stock, if the stock's still at $100 and it's a $100 strike price, there's no juice. Like, nobody in their right mind would pay you any premium to buy that, because they could just go buy the stock for 100. Why not just buy the stock for 100 with 1 second left before it expires? And if it's a $105 stock and it's a $100 strike, you're $5 in the money. You have $5 of protection amount that you have to buy back, but you're not buying back the juice. Does that make sense? So in this particular scenario, you're pocketing $2 of juice every week, net juice. You're not pocketing the protection amount per se, because that's kind of offset by your base position. But let's keep the base position out of this now. I want to just focus on what you collect, because that's what the cash flow machine is all about. It's not about what the stock is doing. It's about what you're collecting. And we're collecting the juice. And the juice has time decay. And as it approaches Friday, when it expires, it's got zero juice left. I hope you got that. I want to drill it into your head, because I know this is going to cause questions for you later. And that's okay. I want to be able to have you get these questions out now, because that's the way the system is designed. All right, here's the takeaway. We collect the juice. Now, since you sell and you collect juice, that's time premium, same thing. When you buy back, there's no juice, because right before expiration or at expiration, there's no juice left. There's no time premium left. That erodes over time, as you know. So since you pay nothing when you buy back, remember, we're buying low and selling high in reverse order. We're selling high and buying low. When you buy back, it doesn't matter if the price went up $1,000, you're just not buying back the juice. And if you have a base position, again, I don't want to focus on that, but if you have a base position, your base position went up $1,000. So even though you might have to buy back the call, with PA, protection amount, in the money amount, you have to pay $1,000 to buy it back. Your bottom line increased by $1,000 because your base position increased by $1,000. Those two are offset. What's not offset is that you picked up the juice because it expired at zero. So since you pay nothing when you buy back, you keep the juice you sold, whether the stock goes up or the stock goes down. This, I want you to just burn this slide into your head, because this is what the cash flow machine is all about. It is not about whether the stock is going up or down. Trust me, this is a question you're going to have. Wait a minute, the stock went up. Yes, it did, and your base position went up. Wait a minute, the stock went down. Yes, it did, and the protection amount went down. All those things are offset. What you focus on is the juice. We just collect the juice. Here's the cash flow machine motto. We just collect the juice. And so anytime you have a question or a comment about the cash flow machine, you got to go back to this cornerstone. We just collect the juice. So I want to give you some scenarios, right? We have to make some assumption. In this scenario, we're going to say the stock stays the same. So let's say that you buy the stock at $100 and that you sell the $100 strike price, call sold, okay? The price you receive is $2 for that call. And then when you buy it back, I'm just showing you how the columns are set up. When you buy it back at the end of the week or the end of the month or whatever, you have to pay 20 cents, let's say, because there's just a little bit of time premium in it, a little bit of juice left in it. So trying to be a little bit realistic here, that there's maybe 20 cents you have to pay to get out of that. It's a pretty good percentage, right? You made 90% on your trade, or you made $1.80, okay? So your cumulative gain or loss is $1.80. So your basis now in your stock, if you want to look at this as an alternate way to look at it, your basis has now been decreased to 98.20. Now, I don't look at it that way. I choose to look at it as how much income I'm getting. I look at the $1.80 that I'm getting, and that's how I choose to frame my mind. But a lot of people like to do this defensively, and so you can look at it as your basis is going down. Eventually, if you do this long enough, you get a free stock, and then it's an infinite return. But let's be more, well, I like to look at it as more realistic because I look at it as from an income perspective. So the next week comes along, the stock stays the same. We're going to assume the stock stays the same for 4 months, okay? Now that never happens, but you got to give me some leeway here, right? Again, you sell the call, you pick up $2, you buy it back for 20 cents at the end of the week when there's almost no juice left in it. You net gain $1.80. Now you're up to $3.60 cumulative gain or loss. You see how that works? And if you're playing defense, your basis has gone down to 96.40. The stock is at 100. You sell the call in the third week, you get $2, and on and on and on and on and on until we get to the 16th week. Notice, if you've been keeping track on the defensive side, you've brought your basis down to 71.20. Well, shoot, you only had to pay 71.20, but the stock's at 100. That's pretty darn good. You're already up like what, 30%, something like that? Well, when we look at it the other way, how much cumulative gain or loss have we gotten? We've got almost $29, $28.80. When you divide $28.80 by what you paid for the stock, you got a 28.8% return on investment on a stock that didn't move. 28% return on a stock that stayed exactly the same for 4 months. All right, got that in your mind? Why? It's because we're just collecting the juice. $1.80, $3.60, $5.40, $7.20, the juice starts adding up. Stock doesn't move. Well, a little unrealistic. Let's say maybe we get into a stock that trends down for 4 months. In this scenario, the stock is going to trend down. Let's take a look. We started at 100, and we're going to just assume that it goes down 2% a week. Now, I don't know a lot of stocks, especially something like an Apple, that's going to go down 2% a week so that it goes down a lot. But we're going to assume that for 4 months, all this stock does is 2% a week. So we're going to sell the 100 calls. We're going to get $2. We're going to buy it back the next week, and then we're going to sell, when the stock's at 98, we're going to sell the 98 calls. A lot of times there are 98 calls, 97, 96. So we're going to assume that those are there, and we're going to do the same thing. We're going to collect $2 worth of juice. We're going to buy it back for, for 20 cents, $1.80, and we're going to do the same exact thing we just did. This is if the stock is going down. Okay? Notice how your basis is to 71.20. Looks familiar. And however, the stock now is down to $70 on that 16th week. So the base position lost $30, but you gained $28.80. So you end up losing on a stock that went down, what, 30% or more, actually? You end up losing 1.2% return on investment on a stock that went down a lot. It just trended down. Now, not every stock just trends down 2% a week, but sometimes they just drop, and that happens too. And we have scenarios for that as well called defending your position. But before we get into that, let's look at this scenario. Stocks drops $7, and then it trends down from there. So we start at 100, and boom, the next week immediately goes down to $93. Well, we had to buy back our call at 20 cents. Let's just make the same assumptions. And now we're going to sell the 93 at the money calls. Now, there's a system that talks about whether we're at the money or in the money, but we're going to have to make some assumptions. So we're doing the 93 calls. We receive another $2, buy it back for 20 cents, and then on and on and on for this next 16 weeks. Your base position has lost $35. 35%, let's call it, right? But what we've done is we've continued to collect the juice, so we've only lost 6% on that scenario. So if you focus on the juice that you're collecting, everybody, that's where the money is, right? So even though that stock went down that you wanted to own for a long-term period of time, it went down 40% or close to it, you're still only down a little bit. And there are things that you can do called defending your position where you can make that even less. But even if it just jumps down $7 and you miss that gap, you're going to be able to make up for it because you're going to be collecting the juice. Now, stocks probably don't just drop down 7%, go down 2, go down 2, go down 2, go down 2. They might drop down 7%, go down 2, go down 3, go down 5, and then bounce back up. But I can't do all the scenarios, right? That's what trading is all about. You're going to have to learn this yourself. But I want you to understand, I gave you 3 scenarios. Stock stays the same, stock trends down, stock drops and trends down, and you still weren't too bad, right? On a stock that went down 35%, you still only lost 6%. Could have been much worse if you weren't in the cash flow machine. All right, let's go back to our cornerstones. Number 1, we assume that we have a stock that we want to own longer term. Number 2, the stock is not going out of business or it's dropping significantly. We want to make sure that that's the case. Otherwise, we shouldn't be in it. There's times to be out of the stock too, by the way. Number 3, the stock goes up and the stock goes down, and each period we sell in the money at the money calls. We never go out of the money, ever, in the cash flow machine. Because the stock moves up and stocks move down, and we want to be able to have protection amount in the right environment. And basically, that means that each period, we just collect the net juice. We collect the juice. That offsets the moves of the stock down. That offsets the moves of the stock up over time. If you look at this on a week-to-week basis, yeah, your account's going to show up or down or sideways. But when you look at it from a year out, looking back on a stock that you wanted to own all year, maybe it went up, maybe it trended down a little bit. Most likely it probably stayed the same, whatever, or maybe went up because we chose the right stock in the beginning. If we look back and all we say is we collected $2 of juice for 50 weeks, that's $100 of juice. Notice how we only paid $100 for the stock. That's 100% return on our investment. So I want you to understand that the time decay plays a role in the cash flow machine. It's the biggest component. And this is a different mentality than you've ever been exposed to in any other trading system. It's the new math, let's call it. But if you focus on only the collecting of the juice, that's when you're going to be calm. Because if you just journal that you collect juice every week, you look back and you go, wow, I got $2 a week, $2 a week, $2 a week. And pretty soon it starts to add up. And if that stock doesn't go down 40%, you're going to be making some good money because it's $2 a week. Now, I know it doesn't sound like a lot, but it adds up. That's the point of the cash flow machine. But there are some swings. The stock can go up 10 points. The stock can go down 10 points. The stock can go down 7 or up 10, up 7. And most of those times you're going to be offset with your base position. And so if you just focus on the juice you're collecting, you're going to be way better off. The cash flow machine has got a motto. We just collect the juice.
Hi, Mark Yagi here, wealth architect and author of this book on my covered call investing system called the Cash Flow Machine. Listen, what you just saw is just one part of creating reliable income of 2 to 4% a month from the stock market. But if it were that easy, then everyone would do it, right? If you want to learn how I create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what I do when the market goes against me, what I do when the stock goes against me, how to adjust my trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. And best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to cashflowmachine.io to learn more, or click this link for more videos, masterclasses, and free resources. See you there.